Tax law changes affecting real estate investors. In this video, I'll discuss some of the potential changes to the tax laws that could affect real estate investors. My name is Duke Ong, and I'm a multifamily syndicator, where I help busy professionals earn passive income through multifamily investments. In this video, I'll discuss the infrastructure bill, tax planning for 2021, and reconciliation. Quick disclaimer, I'm not a CPA, so please consult your tax professional, since this is for educational purposes only. Before we do that, make sure to like, subscribe, and turn on notifications. The current bipartisan plan focuses spending on transportation, utilities, and pollution cleanup. There are pullbacks for spending on clean energy and electric vehicle adoption. It will also eliminate spending on innovation, buildings, and in-home care. So, how are they going to pay for it? First, through the Employer Retention Credit. By ending the ERC early, this will make wages paid after September 30th, 2021 ineligible for the credit. Second, through crypto asset reporting. This is done by imposing new crypto asset information reporting requirements on brokers. A broker is expanded to include anyone who, for consideration, effectuates transfers of digital assets on behalf of another person. Digital asset is defined as any digital representation of value which is recorded on a cryptographically secure distributed ledger or any similar technology. Some examples of these include NFTs and cryptocurrency such as Bitcoin. Schumer says the Senate will immediately consider budget after infrastructure bill, targeting September-October for next big decisions on taxes. The first step is for the budget resolution to be passed to allow the Congress to pass budget reconciliation. The moderates want to first know what the budget recon bill is going to look like before voting on the resolution that will start the process. Time will tell how this will play out. In April 2021, the Biden administration announced the American Families Plan. This proposed significant tax law changes to increase taxes on corporations, high net worth individuals, and provide more resources to enhance IRS tax enforcement efforts. On May 28, 2021, the Department of Treasury issued a report entitled General Explanation of the Administration's Fiscal 2022 Revenue Proposals, which included more details on the tax law changes previously proposed in the American Families Plan. Currently, the top income tax rates are a maximum of 37% on incomes of $628,300 or more for married couples and $523,600 or more for single individuals. This is only the federal tax rate. For those in Hawaii, the rate is a maximum of 11%. Under the plan, the top income tax rates would be a maximum of 39.6% on incomes of $509,300 or more for married couples and $452,700 or more for single individuals. If you're in Hawaii, that would be a combined tax rate on individuals of 50.6%. State taxes paid can only be deducted up to $10,000. Currently, the capital gains rates are 0% for incomes between $0 and $80,000, 15% for incomes between $80,000 and $496,000, and 20% for incomes at $496,600 and greater. Additionally, the net investment income tax is 3.8% on certain investment income of individuals that have income above certain threshold amounts. Under the plan, capital gains would increase to ordinary income taxes when married couples' income exceeds $1 million. For example, a taxpayer with $900,000 in labor income and $200,000 in preferential capital income would have $100,000 taxed at ordinary income tax rates. What are the implications of this? Deals could be slowing down, waiting for clarity, or being repriced accordingly. This could affect the timing of sales for when income is below the threshold. This could also lead to more installment sales or seller financing. The effective date of capital gains increase is proposed to be after April 28th, which was the announcement of the plan. The effective date of changes to estate taxation of capital gains will be the beginning of calendar year 2022. American Families Plan estate taxes. So currently, regarding estate taxes, beneficiaries receive a step-up basis in assets. Biden believes appreciation in asset value during the decedent's life is escaping taxation. Estate or gift tax applies if fair market value exceeds $11.7 million. The theory is that the income generated to accumulate wealth was already taxed since they were assets acquired with post-tax money. The state tax rate is up to 40% for $1 million or greater income. Under the plan, state taxes are taxed as a capital gain at time of transfer or death. It will be calculated as fair market value at date of death over the basis. Beneficiaries will receive a step-up basis in assets. As for gift taxes, capital gain tax would be assessed at the time of the gift. If the exclusion applies, then it would be the carryover basis. If the exclusion does not apply, then it would be the stepped-up basis. The exclusion is $1 million. If your primary residence is part of an estate or gift, you would receive $250,000 or $500,000 exemption from the gain, depending on if you're single or married. Transfers of property into trust, partnerships, or an S-corp could trigger this tax if the property was not previously taxed. So what can you do about this? You could use your exemptions and/or use the exclusion for transfers to your spouse. Currently, under Section 1031 for like-kind exchanges, owners of the appreciated real property used in trade or business or held for investment can defer gain on the exchange of property for real property of a like kind. The tax on the gain is deferred until a later recognition event, provided that certain requirements are met. Under the plan, the tax deferral of the gain will be limited up to an aggregate amount, $500,000 for each taxpayer, or $1 million in the case of married individuals filing jointly. For like-kind real property exchanges, any gains from like-kind exchanges in excess of amounts during a taxable year would be recognized by the taxpayer in the year the taxpayer transfers the real property subject to the exchange. This is effective for exchanges completed in taxable years beginning after December 31st, 2021. Some clarification is still needed for 1031 starting in 2021. Some other changes include the following. The corporate income tax rate increases from 21% to 28%. Many foreign investors own through corporations to avoid FIRPTA and HARPTA and filing personal income taxes in the U.S. For S-corporation owners and limited partners, all income will be subject to either self-employment tax or net investment income tax. There will be an additional 3% tax on income from Medicare. In addition to Medicare tax assessed on wages, if income is not subject to self-employment tax, then net investment income tax would apply. The bottom line is that this will remove the primary benefits of S-corps. Profits or carried interest would be subject to ordinary income tax rates, not capital gains. The Low-Income Housing Tax Credits program will get a boost to incentivize more low-income housing developments through credits. There's going to be a new market tax credit, which is an up to 39% tax credit for qualified equity investments made to acquire stock in a corporation or capital interest in a partnership that is a qualified community development entity or CDE. The investment must be held for a period of at least 7 years and must have been made within 5 years after the CDE receives an allocation out of the national credit limitation amount for that year. The CDEs in turn would make investments in low-income communities. The renewable energy credit is now back to a 30% credit rate through 2026. You will be able to claim a direct cash payment, not just a tax credit. Because it's not clear yet what provisions will pass and the effective dates of those changes, planning for these will be difficult. The bottom line, in my opinion, is that if you're considering a sale of an asset, it might be best to complete the sale in 2021 to assure yourself of the current capital gains rates. You can currently gift assets using the $11 million exemption, which could change. The rules for bonus depreciation are still in effect, so consider doing a cost segregation study if it makes sense. Opportunity zones, energy credits, and qualified business income are still valid. Also, meals are still deductible. Opportunity zones are a form of tax shelter investment. This allows for temporary tax deferral of capital gains, with a step up in basis by 10% for 5 years. There is also a permanent exclusion from taxable income of capital gains from the sale or exchange of an investment in a qualified opportunity zone fund if held for at least 10 years. For planning purposes, you must invest by the end of 2021 to receive the 10% deferral of gain. The qualified business income deduction states that 20% of QBI is deductible for each trade or business. This is limited by the greater of 50% of the taxpayer's W-2 wages allocable to QBI, or 25% of the taxpayer's W-2 wages allocable to QBI plus 2.5% of the unadjusted basis of the taxpayer's qualified property. The specified service, trade, or business and the W-2 wage limitations do not apply to taxpayers with taxable income under $315,000 for married taxpayers filing a joint return, or $157,500 for all other eligible taxpayers. The limitations are phased in for taxpayers with the taxable incomes between $315,000 and $415,000 for married taxpayers filing jointly, or $157,500 and $207,500 for all others. A cost segregation study is a systematic engineering-based analysis and classification of all capital expenditures associated with a newly constructed, renovated, recently purchased, or existing property. This will break down the components of the asset into real and personal property so that depreciation can be accelerated into the first year of ownership. These generally benefit taxpayers with a commercial property having a depreciable basis of $750,000 or more. Those who have constructed, purchased, expanded, or renovated commercial properties, and lessees and lessors who have made improvements of $750,000 or more. A properly completed cost segregation study will maximize tax deferrals through accelerated depreciation, which would increase cash flow through a decrease in tax exposure. There is a potential for a big catch-up via depreciation recapture at the time of the sale. Generally, this will minimize taxable gains on the sale of the property. We currently use cost seg studies on all of our multifamily acquisitions to make our investments one of the most tax-efficient vehicles available. Bonus depreciation is the exception to the normal depreciable lives of property, which are 5, 15, 27.5, and 39 years. Bonus depreciation would be expanded. There's an immediate 100% expensing of capital investments before 2023 with a phase out through 2026 of 20% per year. This has been expanded to include used property versus only new properties. Alright guys, that's it for this video on tax changes. If you enjoyed this video, make sure you leave a like, click the subscribe button, as well as the notification bell next to that to continue to learn more about real estate investing. If you are looking to relocate to Oahu, I'd love to help you out. I'll leave my contact info in the description below. Thank you so much for watching, and I'll see you in the next video.